Oil has been above $100 a barrel for over a month. The Strait of Hormuz is still effectively closed, and yet Wall Street surged 400 points on nothing more than a promise. President Trump told the nation he would end the Iran war fairly soon, and traders treated that sentence like a ceasefire treaty. The Dow jumped over 400 points. The S&P 500 and Nasdaq each climbed roughly 1%. Airlines led the charge, with United and American soaring on the hope that jet fuel costs might finally ease. Oil fell 2.2% to $99 a barrel, the first time it has dipped below triple digits in weeks. But this is the pattern the market has learned under Trump. Analysts coined a term for it last year during the tariff wars. TACO, Trump always chickens out. Escalate, terrify, then reverse course and claim victory. The problem is that war does not toggle on and off like a tariff. Iran denied that any talks have occurred. The Strait of Hormuz remains closed to commercial traffic, and oil analyst Rory Johnston warns that a physical supply air pocket is building on the water right now. Tankers stopped flowing 5 weeks ago, and that gap between paper barrels and physical barrels has to reconcile eventually. When it does, it reconciles toward physical. Goldman Sachs flagged that markets are already starting to price in a Fed rate hike, not a cut. The probability of 0 rate cuts in 2026 has climbed to 31% on Polymarket, with a 97.8% chance inflation exceeds 3% this year. Nouriel Roubini spelled out the math. If oil stays above $100 through April, the inflation impact becomes large enough that the Fed may have no choice but to tighten. That would turn a relief rally into a trap. That same tension between sky-high ambition and physical constraint showed up in a very different corner of the market. SpaceX filed confidentially for what could become the largest IPO in history. The target valuation sits at $1.75 trillion, roughly 94 times its 2025 revenue, dwarfs Saudi Aramco's record $29.4 billion offering in 2019. Advisors believe SpaceX could raise more than $75 billion. The engine behind that number is Starlink, which generated nearly $16 billion in revenue and $7.5 billion in EBITDA last year on explosive subscriber growth. But the filing comes with a complication. SpaceX absorbed Elon Musk's AI company xAI in February in an all-share deal, adding business integration complexity that is difficult for investors to underwrite. And Gary Black of the Future Fund raised a pointed concern. Tesla shareholders who want in on SpaceX will need to sell Tesla stock to fund it. That creates a direct selling pressure channel between two of Musk's own companies. The broader space sector already moved on the news alone. Rocket Lab jumped 3.6%, Intuitive Machines gained 4.7%, and EchoStar surged 6.6% ahead of a planned $17 billion asset acquisition by SpaceX. Musk plans to allocate over 20% of shares to retail investors, double the typical IPO allocation. If the deal price is at the high end, it would raise more than every U.S. IPO of last year combined.
The thread connecting all of this is the growing cost of ambition meeting the limits of infrastructure. Oracle laid off an estimated 30,000 workers this week to help fund its AI data center buildout. The company carries $553 billion in remaining performance obligations tied to AI training contracts, much of it concentrated in a few frontier AI developers like OpenAI. But Oracle is operating with negative free cash flow and rising leverage. Analysts at both project that free cash flow margins will stay negative through fiscal 2029. Meanwhile, the physical bottleneck is tightening. Bloomberg reported that the U.S. data center boom is hitting a transformer crunch, and gas turbine prices are surging as hyperscalers compete for power generation capacity. Micron told a different side of the same story. Revenue nearly tripled year over year to $23.86 billion as AI memory demand overwhelmed supply. Key customers are receiving only 50 to two-thirds of requested chip volumes. The stock rallied 11% on the results, but remains 19% below its March high because investors are focused on the capital expenditure required to scale the next cycle. Fed economists added a warning. AI hype may be overheating the economy, whether or not the technology delivers on its promises, contributing to what they called an inflationary surge. The weight of evidence points towards this AI infrastructure cycle sustaining itself through 2026, but only if two conditions hold. Financing markets stay open for the capital-intensive build-out, and energy costs do not spike further from the Iran conflict. If oil stays above $100 and the transformer shortage deepens, the timeline stretches and the margins compress. The first test comes this week when Trump addresses the nation on Iran. If Hormuz reopens to commercial traffic, oil drops and the entire AI build-out timeline accelerates. If Iran denies talks again and oil pushes back toward 110, the squeeze on power costs feeds directly into data center economics.